Good morning and welcome to Earnings Echo. While my bosses were asleep, we put together the most important information about Palo Alto Networks.
We're looking at the Q2 fiscal year 2026 results that dropped yesterday, February 17th.
And it's a really interesting picture. It kind of creates this classic good news is bad news paradox.
It does, because on the surface, the numbers themselves look stellar. Palo Alto reported Q2 revenue at $2.6 billion.
Which is a 15% increase year over year.
Right. And non-GAAP earnings per share hit $1.03.
So a clean beat, a really clean beat. Consensus was looking for revenue closer to, what, $2.58 billion?
Yeah, and an EPS topping out around 93 cents, so they cleared both hurdles easily.
Yet, if you looked at the ticker after hours, the stock was down, significantly down, about 8%. The market is clearly seeing a red flag that those headline numbers are hiding.
And that red flag is the guidance. The sell-off is almost entirely driven by the guidance.
So what do they guide for?
Well, this is the tricky part. They actually raised the revenue outlook for the full year.
But they took a hatchet to the earnings forecast.
Exactly. They cut the full-year EPS guidance way down to a range of $3.65 to $3.70.
And analysts were modeling up to $3.90 before this. That's a huge cut to profitability.
It's a very significant cut.
Is this them just being conservative, or are the margins actually deteriorating?
It's the bill coming due. They have to digest two massive acquisitions,
CyberArk and Chronosphere.
CyberArk, the $25 billion identity deal, and Chronosphere. Integrating those operations is expensive, and it is hitting the bottom line right now.
Which all links back to CEO Nikesh Arora's big platformization strategy.
It does. He is aggressively pushing these free test phases, bundling products, just trying to lock customers into the whole ecosystem.
He's front-loading the cost of customer acquisition.
That's the bet. Give him a taste of the integrated platform now. You secure that long-term, high-value contract later. But it creates short-term margin pressure. It strains the cash flow.
So the market just sees expensive growth. Even with their next-gen security ARR.
The NGS ARR, right? That tracks their cloud and AI recurring revenue.
Even with that growing 33% to $6.3 billion, investors are still flinching.
Because the market was used to seeing growth rates north of 40% in that segment.
So it's a deceleration.
It's a perceived deceleration combined with an earnings cut. And that's how you get an 8% sell-off.
Okay, so despite that stock reaction, how did management sound on the call? Were they worried?
Not at all. They were surprisingly confident, and it was largely because of the AI story they're telling. Wow. They highlighted a major win where Chronosphere just secured a 9-figure expansion deal with a leading AI model provider. That's a massive validator right out of the gate.
And did we get any hard numbers on the integration itself?
We did. Chronosphere contributed $200 million to ARR just this quarter, and the CyberArk subscription portion is already sitting at about $1.2 billion in ARR.
So they are pulling their weight on the top line.
Yes. They're just costing more on the bottom line for now.
I heard there was some friction during the Q&A, though.
There was. Analysts Brad Zelnick and Rob Owens, they really pressed hard on the existential risks from generative AI.
Which is the billion-dollar question, isn't it?
It is. The core question was whether AI and large language models eventually make parts of the traditional security stack, specifically things like SIEM, just obsolete.
Right. If an AI can analyze threats instantly, do you need these old, heavy infrastructure tools? If AI writes the code and secures the code, where does Palo Alto fit?
Aurora's argument was the complete opposite. He says the battleground is actually shifting to the endpoint, the devices, the applications, because that's where the resource intensity is for AI.
So his whole platformization strategy is a defense against this.
That's his view. That it's the only way to anticipate these shifts, because you need the data from the network, the cloud, and the endpoint all in one place to secure AI effectively.
So the long-term story here is just a massive, massive bet on consolidation.
Precisely. They are targeting, $15 billion in next-gen ARR by fiscal 2030.
So the echo for you, the investor, is really a test of your stomach. You have to decide if you can handle this expensive growth phase.
You're sacrificing near-term margins and EPS to digest these huge acquisitions in exchange for that 2030 target.
That's the trade-off. Volatility now for a dominant market position later.
If they can pull it off.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.